Hey, there's Joe Henry, the semi-retired guy, bringing you another video on stock investing. Well, I certainly don't need to tell you that the coronavirus has wreaked havoc on the markets, and that in spite of this, the major averages have not only recovered their losses, but in some cases, like the Qs, prices are actually higher now than they were before the pandemic crisis began back in March. So what's going on here? Have people lost their minds? Is there a disconnect between Main Street and Wall Street? And most importantly, are the markets now overpriced? Are we in a market bubble? And is the bubble about to explode? Well, to determine if we are indeed in a bubble, we can look at a few indicators that have been developed over the years to help us figure this thing out. The first one is called the Buffett Indicator, named after, guess who? Yes, the Oracle of Omaha, Warren Buffett himself. So this indicator is defined as the ratio between the total market value of the entire U.S. stock market to the U.S. GDP. Now, to find the current value of the U.S. stock market, we look up the current value of the Wilshire 5000 index. This index is intended to measure the performance of most of the publicly traded companies headquartered in the United States. The index includes a majority of the common stocks and REITs, primarily through the New York Stock Exchange, the NASDAQ, or the American Stock Exchange. Now, limited partnerships and ADRs are not included. Although this index originally contained 5,000 stocks when it was started back in the 70s, it currently contains 3,415. But it's easier to say the Wilshire 5000 than the Wilshire 3,415, isn't it? Anyhow, as of July 31st, 2020, the current value of the index is $33.1 trillion. Here's a graph of the total market value of the U.S. stock market, brought to you by our friends over at currentmarketvaluation.com. Now, the denominator of that ratio is a U.S. GDP, better known as the gross domestic product. Now, the GDP is the total value of goods and services produced in this country during 1 year. Now, where do we find that information? Well, we go to the Bureau of Economic Analysis within the U.S. Department of Commerce. Now, these bean counters have put together a collection of information which will put you to sleep quicker than an Ambien washed down with 2 fingers of Pappy Van Winkle. Believe me. So it's important to get your information quickly on their website and then get out. Now, here's a graph of the U.S. GDP over the last 70 years. Again, compliments of currentmarketvaluation.com. From the government website, we see that the GDP decreased 34.3%, or $2.15 trillion, in the second quarter of 2020 to $19.41 trillion. Now, some smart guys over at currentmarketvaluation.com have mapped out this relationship between market valuation and GDP, and have produced a very interesting graph I'm showing you right here. It's called the Detrended Buffett Indicator. What this graph shows is that when this ratio gets to be about 2 standard deviations away from its historical norm, bad things happen. You can see that it reached that point back in 1968. If you look at a chart of the S&P 500, you'll find that in October of that year, the market peaked along with the Buffett indicator. From that point on, the market slowly but surely fell, finally reaching a bottom in 1982, 14 years later. Now, another example of how this works. You can see that this ratio again got to be about 2 standard deviations away from its norm in August 2000. That's at the height of the dot-com bubble. Over the next 2 years, the market plummeted about 45%, finally reaching a bottom in October 2002. It should be noted, however, that this is not a particularly sensitive indicator for any old market downturn. So, for example, during the financial crisis, 2007, 2008, this ratio never got to even 1 standard deviation above the historic norm, and yet the market tanked. Why? Because the reason for the crash was not excessive market valuations like we have today, but instead the bankruptcy of several major banks as a result of losses on mortgage-backed securities, which were in default. Turns out the smartest people in the room are pretty dumb. So that's it with the Buffett indicator. Now let's move on to another one. This one's called the cyclically adjusted PE ratio, or the CAPE ratio, or the Shiller PE ratio. Now, this indicator uses earnings per share over a 10-year period to smooth out fluctuations that occur over different periods of the business cycle. The CAPE ratio is calculated by dividing the current price of a broad stock market index like the S&P 500 by the average inflation-adjusted earnings of its components over the past 10 years. It was developed by a Yale University professor, Robert Shiller, who won a Nobel Prize in economics, hence its alternative name, the Shiller PE ratio. He looks pretty satisfied with himself, don't you think? Now, the CAPE ratio and market crashes, there's an extremely high CAPE ratio means that the price, for example, the S&P 500, is substantially higher than its earnings would indicate, and therefore overvalued. The CAPE ratio has been pretty accurate in identifying bubbles and market crashes. The historical average PE ratio for the S&P 500 is between 15 and 16, while the highest levels of this ratio have exceeded 30. As you can see in this graph of the CAPE ratio versus the S&P 500, record high levels have occurred 3 times in the history of the United States financial markets. Now, the first time was on Black Tuesday in 1929, before the Wall Street crash. The ratio was 30 at that time. The second was in the late 1990s, just before the dot-com crash, when it was 45. The third came in 2007, before the financial crisis, when it was 27. So that's a pretty decent record of predicting market crashes in my book. So what does the CAPE ratio tell us today, August 20th, 2020? Well, first of all, you may wonder, how are you going to calculate this thing? My answer is you need to go to a website where someone's already done the work for you. Here's the one that I use. Talk about a no-frills website. Well, it does the job anyhow. I'll just come right out and tell you right now that the CAPE ratio today is currently 31.22. Should we be afraid? Better grab that bottle of Pappy Van Winkle. Well, let's move on. There's also some technical indicators that you can follow to let you know when we're nearing a market top, if not an impending crash. The first technical indicator is called narrowing of the market breadth. So what do we mean by narrowing of the market breadth? Well, the healthiest market is one in which the majority of stocks are participating. They're all going up. But as bull markets age, this participation tends to narrow. The lower quality stocks are left behind, and investors increasingly are focused on the highest quality ones. The ones that are making new highs day after day and week after week. Well, does that sound familiar to you? It should. What about Microsoft, Amazon, Apple, Google, Facebook? So just 5 stocks right now currently account for a whopping 20% of the market cap of the S&P 500. Well, looking back in time, the 5 largest companies in the S&P 500 during the dot-com bubble accounted for 18% of the index's market cap. Conclusion, market breadth is even narrower today than it was before the dot-com crash. Not good. Well, how long can investors expect this extremely narrow market breadth and mega cap concentration to last? Well, Goldman Sachs noted that while the average episode of a narrow market breadth lasts 3 months, the longest period has been 27 months from 1998 to 2000, so don't hit the sell button quite yet. Another way to judge market breadth is to look at the advanced decline line. This line is simply a running daily total of the number of stocks on the New York Stock Exchange that advance minus the number of stocks that decline. Now, when the major indexes are rallying, a rising advanced decline line confirms the uptrend, showing strong participation. Now, if the major indexes are rallying and the advanced decline line is falling, however, it shows that fewer stocks are participating in the rally, which means that the index could be nearing the end of its rally. In this slide, the advanced decline line is the upper graph and the NYSE composite is the lower graph. You'll see 2 bearish divergences here from June to November in 2007. The first one occurs from June to July. As the NYSE composite moves to a new high, the advanced decline line peaks at the beginning of June and then begins to fall. Well, shortly thereafter, you can see that the NYSE composite makes a significant drop. The second bearish divergence occurs from October to November. Here again, the NYSE composite makes a higher high, while the advanced decline line makes a lower high, forecasting another big drop in the NYSE composite. Well, how does the advanced decline line look today? In this slide, the advanced decline line is found in the lower half of the slide and the NYSE composite in the upper half. For the past several months, the advanced decline line has pretty much confirmed the movement of the NYSE. There are some minor divergences, however. You can see that from July 20th to the 27th. But while the NYSE composite price was going down, the advanced decline line was still going up. This was a bullish divergence, indicating that while the rally wasn't really the rally really wasn't over yet. However, the current market has pretty much been going sideways for the past 7 days, while the advanced decline line, you can see here, slowly moving down. So there is a little bit of bearish divergence going on right now, as of August 20th, 2020, indicating that the market is probably going to take a breather very soon. Well, the third way we measure breadth is to monitor the number of stocks on the NYSE hitting new 52-week lows. When the number is greater than 40, while the major indexes are rising to new peaks, that's a danger sign. Well, today there are only 2 new 52-week lows, so on that basis, the market breadth isn't even close to becoming too narrow. Well, I think we've beat the market breadth horse to death, so let's move on to another indicator of market bubbles. We'll call this one irrational exuberance, or crazy optimism about future profits. Remember back in the dot-com bubble days from 1996 to 2000, when the NASDAQ stock index exploded from 600 points to 5,000 points? Well, what do we have right now? There's actually a good deal of negativity in retail investors right now, as gauged by the predominance of bears over bulls in recent American Association of Individual Investor surveys. If we look at their website, you'll see that for the week of August 6th, the 8-week moving average of the percentage of investors who are bullish is only about 25%. This is down 5% from 8 weeks earlier. So the sentiment among retail investors is becoming more bearish. So we are not seeing the crazy optimism about future profits that we would see in a typical market bubble. The third and final technical indicator to look for in a market bubble is heavy flows into stocks without regard to valuation. While regarding mutual fund money flows, beginning in June, taxable bond funds had their greatest quarterly inflows ever, according to data going back to 1993. Meanwhile, U.S. and international equity funds had their worst outflows ever. Well, to get this kind of information, you can just Google the phrase fund flows, and you'll get Morningstar's website and also ETF.com. ETF.com has a nice listing of the top 10 ETFs taking in money and the top 10 ETFs redeeming money. So summing up, there's some indicators we're in a market bubble. There's some indicators that the train has left the station, but no one's quite sure where it's headed yet. Now, in favor of a market bubble, we have a Buffett Indicator, which is currently at a level previously seen just before the dot-com bubble burst. We've got a CAPE ratio at a level seen on Black Tuesday, just before the start of the Great Depression. We've got narrowing of the market breadth as seen by a concentration of 20% of the total stock market cap in just 5 names, and they're all in the tech sector. However, we do not see a bearish divergence in the advanced decline line at this point. On the other hand, we have negative retail investor sentiment trending even further downward. We've got mutual fund money flows into fixed income and away from equity index funds. Now, to complicate matters even further, it may be useful to consider what factors are already priced into the current market and what factors have not been. Now, what I believe has been priced into this market already, first, a quick recovery from the effects of the pandemic has definitely been priced in. Everyone's assuming that the V-shaped recovery we have been looking at so far will not become a W-shaped one, or worse, an L-shaped one. These other types of recoveries could definitely happen where a second, more devastating wave, like the one which happened in 1918, if that would occur this late fall and winter. Low interest rates for the foreseeable future are also priced into the stock market, leading investors to believe that stocks are the only place to find any yield right now. As an example, the 10-year bond's currently yielding about 0.25%, lowest level in history. And this is in spite of the fact that the government has spent literally trillions of dollars to make sure that our too-big-to-fail industries, especially energy companies, autos, airlines, make sure they're not going to fail. Now, analysts say that it's different this time, that inflation will not occur. Well, we've heard that before. What I believe is not priced into this market is this. Approval of a vaccine in 2020 is really not priced into the market. Were this to occur, and the vaccine was actually administered to large numbers of people in 2020 or even early 2021, the market would be pushed much higher. Now, the ultimate severity of the pandemic is not priced into this market. Were the number of deaths to increase dramatically in a second wave this fall? Especially if an effective vaccine was not developed, we would expect the market to fall, maybe precipitously. Well, my conclusions: by some valuation indicators, the market is definitely overvalued. Other indicators point to the possibility of another leg up in this market. About the only thing we can say with any certainty right now is that the market elevator is much closer to the top of the skyscraper than it is to the basement. The best advice at a time like this is to simply review your current positions, trim your losers, don't make any additional purchases, and maintain an asset allocation that you can sleep with at night. If you like this video, please give me a thumbs up. Also consider subscribing so you'll never miss another one of my videos again. Thanks again. Till next time.